So last week, I know I didn't show this. Am I muted right here? No. Last week I didn't show this. This is the group meet. We'll be posting the presentation piece in there, and just do some give you guys reminders before we start, so you can. Telling people to complete the module before they come to class. If I cover it in class, it'll just be a bit of a refresher. Just learning it from here and then doing it. I feel like if we do the modules before and then come to class and then just cover. Also, for the certificate that you have to earn, I also realized that there's only one more section we have to cover, which I think is the equities one to earn the certificate, but there's a few modules that I have to. So in the currency section, emission drivers, central banks and currencies, and currency risk. What drives the currency prices? So there's the financial investors that are foreign countries. There's corporations that borders, business or leisure trips that are needing to convert their currency. Stay there for a while, buy food. So peg currencies, at the end of this, like of the currencies one, I've actually took a list of the Bloomberg functions for the terminal. So you'll be able to take a picture of those. Is what I'd recommend because there's a ton. But the peg currencies are pretty much just currencies that are directly linked to another. So say the dollar and the pound, they have a set value, or like, I don't know the exact number, but it's like $1 equals however many pounds. So that's what a peg currency is. And then when you look on the Bloomberg terminal, it'll show you just a full list of all of them. So what drives the valuation of currency? Surprise changes in interest rates, surprise changes in inflation, and then surprise changes in trade. When there's a surprise change in interest rates, the investors buying bonds will depend on the interest rates to make a decision. And then when a central bank unexpectedly decreases the interest rates, the currency will weaken. Surprise change in inflation is, of course, not very good. It weakens the currency, and pretty much investors will have to pay more money to buy the same amount of the good that they want to buy. And changes in trade. So this is the formula we covered last week, just a basic GDP formula. Exports a good order in their currency. So it works the same way that with importing goods. A trade surplus will drive demand for the home currency, and a trade deficit will diminish the demand for the home currency. So changes in trade will play a big tie in valuing the currency. Here I have the inflation-deflation cycle. This was covered on the Bloomberg thing. I actually took this picture right off of there. It just shows how inflation works, like the cycle a bit. So right here we have workers expect prices to increase, and then of course they demand more money. Then the wages go up, companies raise their prices, and then you're back to expecting the prices to increase. Same works with inflation. Prices decline. Consumers defer purchases to a way. I think the example that they used was like, say you have a rental home or something, you want to renovate the bathroom. They said, like, if you're expecting prices to go down, of course, you're just going to wait. You're not going to renovate that bathroom immediately because prices will go down. And then when prices go down, of course, company revenues decline because people aren't buying things. And then they let go of workers to cut costs, and then prices decline. So these are the inflation and deflation cycle. And then gold is also covered. They labeled it as the ancient currency. It's a non-yielding asset, so there's no dividends or interest gained off of it. But what is beneficial about it is it can't be manipulated. The U.S. government can print the dollar as many times as they want, but it can't print gold, which is good. So that way it hedges against the U.S. dollar, and it's always safe. That's the U.S. foreign currencies. It's not as easily manipulated. So the main takeaways that were covered at the end is the U.S. dollar is the heart of the world currency markets. Economic surprises drive major central banks target a certain inflation rate. Most countries target it at about 2%. And investors can lock exchange rates with forward agreements. This was one of the last one with the forward agreements. This is one of the Bloomberg terminal functions, which I think, sweet, right here. Perfect. So yeah, if you want to take a picture of this, once you actually get on the phone, you'll be able to just type these in. And these were the ones that were actually covered in the modules. So it just shows you all the different things you can do and actual formulas you can use with the stuff that you learned. And then for fixed income, as they put it, was another word for bonds. So this section, it covered the roots of the bond market, bond valuation drivers, central bankers and interest rates, and then the yield curve and why it matters, and then movements in the yield curve. So the roots of the bond market, fixed income is another word for the bond market, where loan agreements are bought and sold. And the growth of the governments has been the main facet giving rise to the $101 trillion world bond market. Investors view U.S. government bonds as the safest, most liquid asset in the world. That's just because the U.S., unlike many other countries, they have a set ability to tax people and then gain a consistent revenue off of taxes. So that's why people are looking at the U.S. as the safest one. And there are millions of bonds outstanding, and investors use yields to compare one bond to another. So bond valuation make account for the duration of the bond. So when you're going through the modules, I think it showed a bond compared to a savings account with a bank. Your sister like $80 to buy a bike, and then she gave $10 back like every year or something. And then it showed that money in a bank account as well. And it was just pretty much teaching you how the bond works versus the putting your money in a savings account instead. So also to value a bond, inflation, bond repayments that yields up. U.S. government bond yields serve as benchmarks for all investments. Yields on other bonds tend to move with them. And most central banks have to mandate to prevent runaway inflation and deflation. Fixed income investors watch hawkishly for any signs of inflation. Central banks closely monitor inflation expectations and the output gap when making rate decisions. And when you're doing these modules, it showed a graph. I'll try to find it at the end when we cover the Bloomberg functions for this section. But it just showed, there was one section that showed interest rates and how it correlated with how confident investors were feeling in the market. And then I think when the graph was like really high, it showed that investors were scared. And that correlates to when inflation is really high. The yield curve and why it matters. The yield curve represents the cost of borrowing for various loan lengths. Yield curves are naturally upward sloping due to elevated risk of long-term lending. Corporate bonds are priced using the spread of the government yields, so the yield curve indirectly regulates company funding. And consumer borrowing for big ticket items prices off of the yield curve. Yield of developed economies are correlated, which means that the overall movements in yields has a global impact. On the yield curve, interest rate set by the central bank. The far right is driven primarily by inflation expectations, while the left-hand end, right-hand end flows freely. A steep yield in the curve signals improving times as compared to a flat yield curve signals worsening times. And an inverted yield curve often precedes the recession. So here's the function for this one. Let me take a look at, if I remember correctly. It was the ILDE that showed inflation rates that showed how investors were feeling about it. The module takeaways for this were that the bond markets keeps governments accountable. Bond yields are driven by creditworthiness, inflation, and interest rates. Not covered on here where it says creditworthiness. It labeled the UK and the US as the most creditworthy countries. Countries that have just been known over time to pay back bonds, and they're typically the most trustworthy. And central banks guard against both inflation and deflation, and central banks influence all borrowing costs via the yield curve. That was the main, pretty much everything covered in the currencies and fixed incomes. And then the next meeting, it'll be on Wednesday, October 27th. Just a quick question in the Zoom or in person. Is this anyone's first meeting? Oh, it is? Okay, perfect. Let me check the Zoom real quick. Anyone on the Zoom? How do we join the group name? I think if you just take if like you have any camera, you just hold it up and scan the QR code right here, and it should pop up a link to get into group name. But to actually create an account, I'm on mobile. Yeah, if you have an iPhone, you can just go to the camera, hold it like right up against the screen, tap on the QR code, and it should pop up a link. But if this is your first time, just go ahead and call UTSA Bloomberg Market. I think these computers might be tough if you do it on your phone, maybe, or if you have a personal computer. But you're going to want to click on that, and then it'll take you to like a library homepage, the UTSA library, where it shows Bloomberg Market Concepts. You're going to click on a link, and then if you sign up with your school email, it should be free.
All right, Jay. So for now, I'm kind of catering this class to you and Camille. And let me just go ahead and get started then. So today, I had already sent you guys out the static model. Since you haven't been able to come in to use Bloomberg, that data won't be fed in with the model that Professor Sweet teaches us how to use. So with this static data, what we're going to do today is we're going to start looking at the firms you selected, what industry they're in, and then also look at their competition. I'm also going to show you some tricks in Excel. So let's get into that. First thing I did if you go to the material specific tab, and Jay, just so you know, this is in your email as well. I sent it to the J period H3RN, I believe that's your email. So if you want to follow along, you can do that, or you can just watch me today. I'm sorry. Oh. Yeah. Okay, sorry about that. No, I had sent it, I believe, a couple weeks ago. Oh, yeah, that's the static model, and the data shouldn't be changing since the periods used isn't going to be updated very frequently. Okay, so let's go ahead. Do you want me to wait while you pull it up? Or? No, okay. All right, so first thing we're going to do is we'll go to the bottom of the data. So you can press Control down on the material specific page. And so I'm going to highlight the columns with your names included as well. So what you're going to do is press Control Shift, press the left arrow, so it goes all the way across, and then press up until it goes all the way to the top. Okay. Now, once you do that, you go into the data section. You're going to go into sort, and you're going to use the sort by section. So we're going to sort by the GICS industry name. So those are the column titles at the top. Then you're going to go ahead and press OK. And I'm sorry, are you in the class too?
Yeah.
Okay.
Sorry,
Cool.
this is my first week.
Oh.
I tried to join up last week, but I think it was canceled, right?
Yeah, yeah, my bad.
What do you need, my email or something?
What's your name?
I'm Xavier.
Xavier. Okay, so this is the first time. Yeah, let me just grab. If you could put your name, email on the bottom of this list. And I'll send this out to you after class, and then the video will be available as well. Professor Sweet posts that on his YouTube channel for the Investment Society. Okay, so first thing I want to cover in here is, as you'll see, your names correspond with a specific industry, right? So David has selected Ecolab. That corresponds with the chemicals industry, right? Now that's a pretty big industry. It has a lot of firms within it. Cameron has construction and materials. Nobody selected containers and packaging yet, and nobody has selected paper and forest products. I'm going to kind of oversee all of them for the time being. Jay, you have United States Steel Corp, right? So since you're in the metals and mining, and Camille, you're also in the same industry with metals and mining with Nucor. I want you guys to kind of get more familiar with the industry, so not just your firm itself. So I'll show you a couple ways to do that, and then also I want you guys to explore a little further. So I'll just use, since, well, actually, Xavier, you're going to participate in the sector?
Yeah, I want to.
Okay. So do you have a particular firm you'd want to examine or kind of follow? Right now, it would be good if you picked something in containers and packaging possibly, or paper and forest products. Those two sectors, nobody has claimed one yet. So just think about that, you know, while this class goes on. I can meet up with you after as well. And, okay, so now that we have this organized, you can see the industry a little more clearly, right? Okay, that's first thing we're going to do. Second thing, we're going to go over into this analysis edited tab. And okay, so in this tab, what I want you to do is, well, first of all, I realize I made a mistake here. So when I wrote what's cheap and what's expensive, as far as our forecast values, it should be the opposite. So just give me 1 second, I'll fix that. And I'll explain how this is going to be helpful in a second. So at the end of this class too, I'll send out the updated model so you guys can follow along and you can see, you know, the progress we're making. So you can try to recreate what we're doing. Okay, so we didn't really cover, if you haven't been able to see the video, the model that we use creates this forecasted column, right? So this is based off of using the regression data, right? And it gives us a best fit line for where we think this firm should be valued at. That's our forecast value. And this is what the market actually has the value at right now. Hold on, let me zoom out a little bit. So this would be for advanced 6 right at the top. So we actually think it's worth more. So this would be cheap, right? And if it was the opposite, if this value was higher than this value, then it would be expensive. So what we're going to do right now is we're going to insert a new column. Okay, so you insert a new column here, and we're going to create an if statement just to easily see if it's cheap or expensive for all the firms. So the way you go about that is you press equals, you type in if, you can press tab, and then you have to enter the logical test. Now, it may sound kind of weird if you haven't used the if statement before, but really all you have to say is, what are the parameters you're looking at? So as I said here, cheap means that your forecast is higher than your actual. So this is forecast, this is actual. So what you can do is you can just create a greater than. So you would use this column greater than this one. So if that's the case, I just think it's real quick. So if this is greater than this, then it's cheap, right? So we can type in, put the quotation mark, put cheap, quotation mark. Can you see it, Kuma? Or let me zoom in a little bit so you guys can see. I just zoomed out so I can see more information. Okay. Equals to, so yeah, can you see now? Okay. So if this is greater than this value, right, then we have cheap. And then separate your statements by commas. So then you're going to type in expensive. So let me explain what this means real quick. So as you see below, it kind of tells you what data you need to put in, right? So first you're using the if, that's the function. Second, it says the logical test. So if this column is greater than this column, that's our test. Then after the comma, you put the value of true. So we want it to say cheap, right? And if it's not true, if it's false, then we want it to say expensive.
I have a question.
Yeah, go ahead, Jay.
Do we need to lock any of these cells or any rows or columns in this formula?
You don't know. In this case, you don't need to because it's a column by column. I mean, a row by row comparison. So when you're copying down all the way, I'm sorry if I misunderstood your question, but if we're copying down to the bottom of our data, you don't have to lock in any of those cells.
Cool.
Okay.
And can you, I guess I missed, what was EV to T12M EBITDA?
Okay, yeah, let me cover that. So let me just press enter.
Sure.
So that's going to be our formula is complete. And you see it gives us our value. So the forecast, Jay, I know you haven't been able to come in, and if you guys haven't been able to run the model which I was talking about, the forecast EV to EBITDA, this is the value that we're getting when we, I'm not doing this justice right now. We're using these three columns, right? We're using the sales or the revenues, the gross margin, and the total debt to EBITDA, right? We're using those three, how do I say it? These are our three predictors of our forecast enterprise value to EBITDA, right? So we're using the regression model. It's kind of hard to explain if you haven't seen the video, but we're using our coefficients. Actually, Jay, let me explain it in a video. I'll put it out.
That's fine.
Yeah, I'll just put a little video for you guys. So it'll explain the model. and then I can explain the static data. So then that way you guys understand a little
Sure,
bit.
sounds good. Thank you.
No problem. So for right now, without me explaining any further what it is, basically we predicted a value by using, excuse me, we predicted a value by using regression model. The values that we get are the forecasted, right? Forecast. And this is what the market actually, this is what the Bloomberg data actually gives us. So again, since we think that it's actually worth 7, it's cheap in comparison to Bloomberg because they're saying it's only worth 3.8. Now, since we just entered in that formula, okay, how you doing, David? Yeah. Okay. So what I just showed, David, is how to use an if statement. I'll go explain after if you want to stick around.
I know how to speak.
Okay, so you got it. So then I just use an if statement, and then we're going to copy down for all of our data, right? So now you'll see each row, it shows whether it's cheap or expensive. And then to me, since this doesn't look very clean, what I'm going to do is go through all the data. I'll press Control Shift, go all the way up, and then we're going to filter this data again. So what I'll do is I'll go to Home. We're going to do conditional formatting. You go into, where is the text? Oh, sorry, highlight cells, rules. And then you're going to go into text that contains. And then you just type in the word, what's that value on that cell. So if it's cheap, that's a good thing. So then I'm going to use green. So I'll use green fill. And then I'm going to do the same thing, conditional formatting, highlight cells, rules, text that contains, type in expensive. You don't have to type in the whole thing. You see it's already highlighted. And then in this case, we'll use red. So just in a few seconds, we're able to see for our whole sector, what are we predicting is cheap? What are we predicting is expensive? Now, what I would do with this information is, again, look at the industry. So, if you're David, for instance, right, you have Ecolab, our model says that it's expensive, right? So do you agree with that? I mean, as of right now, you do agree, okay. And so why do you agree? I'm not putting you on the spot right now, but I'm saying let's go further in the model. Let's try to figure out why do I think it's expensive? And then I was speaking about it just a few seconds ago or a few minutes ago. So since your sector is chemicals, it's pretty big, or your industry is chemicals, right? It's pretty big. Now, one thing you can do is start looking at other chemicals firms, right? So within the industry, a starting point to compare, Ecolab to the other ones would be, what's cheap, what isn't cheap. Oh, sorry. If they have some competition that has like similar revenues, and they're valued cheap, maybe you want to look into that further, right? Because that's something maybe we want to buy. Why is it that way, right? So you seem to understand. Do you kind of understand, Xavier?
No.
Okay, you follow? Okay. Camille, do you have any questions?
No.
No?
I have one question.
Yeah.
So what is cheap and what are we saying is cheap about the company or expensive?
So where it's trading in the market, that's what we're saying.
That's what we're saying?
Yeah.
The price, stock price?
Yeah, well, not based on the stock price, but we're using the enterprise value to the EBITDA. So we're using that as our underlying factor, because within it, we're encompassing the revenues, gross margin, and total debt to EBITDA, which are some of the, those are some of the factors you want to look at more highly, right, when you're valuing a company. So that's what we're looking at. Camille, you had a question? Oh, no. Oh, okay. No problem. David?
So what, you use the whole, data range to go to measure, or just the?
Yeah. So we filtered out, excuse me, so from the material sector, from the Russell 3000, right? I believe it gave us 130 firms initially. I filtered out 24, or actually 27 firms based on some missing data. You know, would their data really skew our data, you know? So after I took out some of those firms, and you'll see here my parameters. Let me explain those a little bit too while we're on the topic. So besides filtering out companies which had, you know, no data or missing data in a certain column, I also created my own parameters, which you guys can do the same, you know, when you're building your own models. And I like to write it down so then I can remember, you know, what did I take out? You know, was that really, you know, something good? Did it provide value, or did it actually maybe, you know, negatively affect my model? So when I write it down, I can also talk to it about, you know, with other analysts, like, this is what I did. What would you do? Do you agree with this? So as we're discussing further, you know, our sector, our models, and you guys build your own, and we talk about it, you know, this is helpful. So you'll see here, you know, if it's greater than 20, less than 20 in this column, then I took it out. So again, I use these filters to get down to 103 firms. So it's not the complete set of materials firms, but it's that's what we use for the model. And so let me see, since we haven't really talked about the model, this is, you'll see I put some notes in there for you guys as you go through. So this, if you follow the videos and you're able to use Bloomberg like here at school, then this is how I arrived to the static model, so you guys can replicate. So this, as I'm explaining, like David, I said, at first I removed the non-applicable stocks where there's missing data. Then you remove the outliers, which are my parameters. Then you run the regression. You follow along what Professor Sweet says. And then these are just some notes, you know, higher adjusted R squared is better. This one's pretty low, so we can try to filter out some more companies, you know, to get a higher R squared. It also, you know, since we have 103 firms, you know, correlation between the firms and their values are, it's going to be harder with that number of firms. I believe Professor Sweet used like 20 or so in your, but I think it was, yeah, it was a smaller set of firms, and so he had like a higher R squared value. But for what we're using, I mean, it's kind of going to be low. It's kind of hard to get around that for using so many firms. But you guys might want to do that, you know, for your own industry. You know, what is the correlation between them? Hopefully, it would be higher, right? And then you can do the same regression model, and, you know, see within the material sector is your industry. You know, are they more correlated? Basically, that's what you're going to get from the adjusted R squared. And the F value, so this is what Professor Sweet says. I just wrote it down so you guys can see, but the F value over here should be greater than 1. T-stats should be greater than 2. So you'll see the ones in green are greater than 2. And obviously this one isn't, so it's in red. And then again, with the p-values, I believe it should be lower than 0.05. So this one is not within that. I should have wrote that down.
Quick question.
Go ahead, Jay.
I noticed that the formulas are not in the summary output of the regression statistics, how are these numbers calculated? Is that also talked about in the video or?
Yeah. So again, with making the data static, that's why I had to remove some of the formulas, and then I also had to hard code a lot of the data. So if you're able to come in, Jay, but, you know, I'm sure you could create the data. I'm also working on trying to do it through CapIQ.
Cool.
But that's new. It might take me a little while, but I'll eventually get that information to you guys. So then we can do it from home, and you know, it'll be easier since we'll all be on the same page.
Got it. Thanks.
No problem. So for today, really, you know, let's pick a firm for you, Xavier, so we can get you started. David, Camille, you know, since you guys have already been looking at your firm, you know a little bit about them, right? Right. So if you know a little bit about them, start looking at the industry and the competition. Use what I'm telling you here. You can see, you know, maybe there's some firms that are interesting to you in your industry. You know, okay, so let's see, like for instance, David. You know, you have chemicals, you have Eastman, you have Element. Let's see real quick. So Eastman right here, they're expensive. Element is actually cheap. Well, okay, maybe I'll look into Element, right? So you can kind of look through it that way. Maybe try to get to know some of the competing firms, and then next time maybe we can talk about it, or you can pull some of that data and you can ask me some questions. You know, what do you guys see when you're looking at the financial statements? Do you think that it's appropriate that they're cheap, expensive, et cetera? So let's start working on that. For today, I think that's pretty simple, but I think it's a good place to start. And Jay, do you have any questions?
I'm good. Thank you.
Thank you for coming in again. And I will see you guys next week.
All right, let's start. We got a couple of people online. Let me share my screen. We've got Bon W, I know who that is, Juan Carlos and Sergio. We got Colin and Nicholas and Marissa in here. All right, so last time what we did, we got our revenue forecast. Let me put some titles in here so you can see. At the end of this, if you want the file, you know, just email me. So we got the revenue forecast. And then I'm putting in green anything that we're forecasting. So we're forecasting the gross margin at 13%. So that gave us a cost of goods sold and a gross margin. Our SG&A, we're doing that as a forecast of revenues. We use 9.5% there to give us an operating income. Interest expense we'll do later. Other expenses, we just look back. It's kind of bumpy, but it's very immaterial. So we just calculate that as 0. So our EBIT, we should be able to just, our EBT, excuse me, we should just be able to copy that over. Did we check to make sure we had a good EBT? Let me go check. Let's see. Income statement. EBT, where's income tax? All right, so 361. Oh, always do the wrong column. So we're starting column I think. That looks good. All right, I think we did this last time, just to make sure. I'm the kind of person where I double check all the time, because the last thing you want to do, you get to the very end and there's some major error. So that looks really, really good. That sums to 62,095, 62,094. So I'm off somewhere, but who knows? There's some miscellaneous thing, but that's not material. All right, so just like that, y'all saw how fast we went from a revenue forecast to an earnings. So the next line is going to be taxes, income taxes. So let's go get the historical number there. See if I can remember to do column I. So income taxes expense is line 52. And so we'll copy that over. And you can probably guess what we're gonna do next, right? We're gonna do tax rate. What kind of tax rate is this, marginal or effective? It's the effective one, right? It's their average tax rate, so we're gonna do an effective tax rate. Right, so we wanna figure out what that is, so we just take income taxes divided by EBT. We'll do a percentage there, 40, that looks good because that was the corporate tax rate back then. Let's see if that continues throughout. All right, and so now we're just gonna put a forecast in for taxes. Now here, the last few years have been, 24 looks pretty good. So here's where you're gonna ask, what is Biden gonna do? What is Congress gonna do? What are they talking about doing? Are they going back to the pre-Trump?
That's the difference of the relocating. They were supposed to get them on Monday, but then now they send because I made a deal where you have medical bills, you have to make.
Well, that's personal, right? Personal taxes?
No, you have to make agreement with the hospital for work.
Hmm.
But when you study with those bills, and they made agreement with, like, you have to, you can file for, Section 8. Yeah, arbitrary.
That I'm not sure about. I haven't heard that. All of it, I've been hearing reports that they want to increase the marginal tax rate for corporations. Should we go pre-Trump? So Trump's tax law came in 2017. That's probably what we're seeing here. Should we go back to 33? What is Congress doing right now? It sounds like they're not getting anything done, right? So, let's put 24, but that's something to come back to. I'm going to highlight it in yellow just so we know. That's something we might want to run some scenario on. I don't think they're going to go much higher than pre-Trump because there was a lot of support from Democrats that the U.S. corporate tax rate was one of the highest in the world, and it shouldn't be the highest in the world. So maybe they don't go back all the way where we were before. So now all we got to do is take our EBT and multiply it by our tax rate. We have our taxes. So I'm going to take, well, the next line obviously is net income. So we just take EBT minus our income taxes and copy that across. And I'm going to check that against my income statement. So net income, line 60, column I. I just want to make sure I've got the right numbers. So let me copy that over. I can go all the way over, except for I'm not going to get numbers. All right, let's see. Oh, I got a problem, don't I? That second year, I'm missing something in that second year, column J. Oh, there it is, 118 right there. Extraordinary items. I thought we already picked those up, 55 and 56. Didn't we pick those up? So what's in our other 55 and 56? All right, I'm gonna do plus lines 55 and 56. Oops. Plus 55 plus, I don't know why that's. Again, some. 55 and 56. Let's see if this works. Nope. So it was probably minus that. We'll see. Did that fix it? There we go. All right, so you see why I keep checking as I go? Because it's not that we're going to do anything with this. We can look at other expenses and just see the sum over the years is still only 154. For a firm that has 154 million, for a firm that has $25 billion, you know, we're talking over many, many years here, over 24 years, 154 million. That's, boy, that's what, even not even 10 million a year. So we can still ignore. I just want to make sure I've got my net income correct. Let's see if I have any other errors. The last year's off. We'll have to figure that out. Why is the last year off? All right. Where am I? What am I missing? Okay, I start missing something here. What is that column? In 2012, I'm missing 58 million. What am I missing in 2012? That's 58 million. There it is. What is that line? 59. Oh, my minority interest, I just, you know, for Costco, it's going to be pretty immature. I don't know why Costco has minority interest. It might actually be pretty interesting to research, but I'm just going to strike it out of that other expenses. Hopefully, maybe we don't call it other expenses. Maybe we call it other items. And so we're going to go, I'm going to try subtracting it again because I'm not real sure. I think we have to subtract it because we're doing it as an expense. So, you know, we have to. So what line was that? Minority interest, line 59. But I mean, that's curious to me. Why in the world, what is it? Why does it give me an error message? I'm not sure I understand that. Yeah, y'all getting that too? I don't know why. It should work. Yeah, I don't know. Got to put a sum function in for some reason. That's really strange. All right, let's try this again. The sum is 41,791. 41,791. So now we got it. It matches. It's perfect. So we're good. I'm going to now graph my net income like we've done before. And that is exactly what we've been seeing before, isn't it? That looks very reasonable. There's like the COVID bump, and then everything's back to normal. So I think we got a pretty good net income forecast. I don't know if we looked at Bloomberg, what they're forecasting, how close we would be to their forecasts. I'm sure they're much higher than we are. But it would be kind of interesting, you know, just to see what they did with the tax side of this. So I'll get into Bloomberg because I do think it's interesting.
Professor Bond says in the waiting room for the.
Oh, sorry. Oh, seriously. Oh, sorry, guys. I thought I took the weight. Oh man, sorry guys. I just assumed over there.
No worries.
Sorry about that. I forget about the waiting room and it doesn't show admit. It just shows y'all's names like y'all were in there. Sorry. All right, I'll refresh what we did anyway because it's a good refresher. And if y'all want the spreadsheet afterwards, you know, you can do that. So, all right, just a quick refresher here. So what we did on the other items, man, everybody's popping stuff up. On the other items, we add a few things at the end. There was some extraordinary items and there was some minority interest for some reason. We just lumped those all in and we just, instead of calling it other expenses, we just called it other items. When you add that up across, it adds up to 700 over 20 something periods. So it's a very immaterial number. So we're just ignoring it and forecasting 0 on that. You might even graph it just to see if there's something that really stands out, like it's getting larger every year. So even then, you take out that 1 year. Yeah, you got that 1 year of 642 in 20. Is that 2020? That 1 year in 642, you take that out, and it only sums to 59. So you got 1 year that's just massive. We can look and see what that is if we want to, but I doubt it's anything that radically important. I mean, and then the question is, is it going to happen again, right? That's what we're worried about. So let's see if we can see that number sticking out here. There it is right there. Other, it's under other. If it's under other, you know, if I were really doing this in real life, I would go to annual report and see what that 600 is. Is this something that might happen again? But, you know, for my purposes, I'm just going to assume it's a one-time item. I mean, you don't, is that the only one they have, right? There was one other for 108 or something, but it's extremely rare. 132, 24, it's just extremely rare. So, you know, the best forecast of that is 0. So I think we're good on there. And then what we did after that is they gave us earnings before taxes. And what I've been doing, Sergio and Bond, is every time I get to a number, I go and check it against the actuals, make sure I didn't miss something. And that's where we discovered that we're missing a couple of items on the other. Then we did the tax rate. And what we did on the tax rate is it's really come down since the tax law changed in 2017. So I highlighted this in yellow because we might come back here and we might argue that Biden's going to kick that back up to 30% or something. So we'll see. But I wanted to look at Bloomberg. And remember there, you just do earnings estimates wherever it is. It's just, well, it's just EE. I don't remember where it is on the schedule, but EE for earnings estimates and net income annual. Y'all look at our, let's see, what is their net income for 2025 is 7,256. Someone remember that number, 7,256. 2025, and we're at 5,650. So as we've been seeing consistently, the forecast on Bloomberg has that COVID jump and they just keep going. We have the COVID jump and we come back down. I think it seems more reasonable to me that Costco is not just going to keep having all these people buy their stuff like that. Does that make you feel good that you're conservative? What's your goal? Your goal is not conservatism. Your goal is what? Accuracy. So, you know, I don't know if it's good that we're conservative. All right, we got net income. Okay, I say this is income statement forecast, but I'm going to put the balance sheet on here too, so I don't have to keep flipping between screens. So now we're going to do the balance sheet. And then we probably won't get much further than that. And then next week is the fun stuff. I actually love creating cash flow statements from balance sheets, income statements. So to me, it reminds me of my old accounting days of ticking and tying all over. In my EMBA class, I used to tell them, you got to check and tie. And one of the students says, "What's a chicken tie?" And so they bought me a chicken tie at the end of the semester. All right, so balance sheet. Let's go see what's in the balance sheet. Let's just look at it. So in fact, what I'm going to do is I'm just going to take the accounts and just copy them down, and we'll decide what we really need. So we'll definitely be consolidating some stuff. All right, so we got assets. What about cash and cash equivalents and short-term investments? Combine those two? I would say yes. All right. I'm going to say cash and short-term investments. All right. Trading asset securities. I'm guessing that's 0, but we'll go look and see. Trading asset securities. Yeah, that's 0 all the way across. No, it adds, well, they had 1 year where it's almost nothing. All right, so we're just going to take that line 21 there. Y'all see that? It just adds them all together. So we can just do that line 21. So that works. So line 21 on the balance sheet for, okay, what year are we doing? Forget what our starting year is. Our starting year is 1998. All right, so balance sheet, line 21 for 1998 is 437.5. So we'll copy that across. I don't know why I have that number out in the middle of nowhere there. What was that? I don't know why I did that. Oh, I was getting me the difference. Okay. Now that number gets pretty large. How are we going to forecast this? We're going to do it as a percentage of assets. It's going to be our forecast. Okay. We'll have to come back. You're going to say, well, how can we have percentage of assets? Because we can get assets until we have cash in short term. We're going to get the circular formula. We're going to show you, David, you saw it in my class the other night, how I do that. So I have my own special way. So that's going to be our forecast over here. We're going to forecast percentage of assets, and I'll show you how I get around the circular formula. All right. We can't actually calculate yet because we don't have total assets in there. All right. The next line is accounts receivable. Let's see if they have other receivables. All right, let's just look and see. Other receivables, they do have them. They haven't had them the last few years. So I'm just going to combine them all together. All right, I don't see any reason to separate them. So we're just going to do total receivables. And I don't know what line that was, but I'll go find it again. 1998. 1998 is column I again, so it's the same as income statement. Okay, total receivables, column I.
This is the balance sheet, and we added all the cash on short-term investments. Why don't we choose to be labeled total assets?
What do you mean, right here, or?
Yeah,
Well, it's cash in short-term investments, right? So,
but you added all three categories up.
well, the last one was trading, and that was so immaterial, I'm just gonna leave it out. So to me, it's just immaterial. There may be some companies, there's gonna be some lines on here that are there just because other companies have it, but they don't. So yeah, to me, trading securities is part of that cash in short term. I don't know what trading securities Costco has. They have it on the short-term assets, current assets. So it can't be like a 20-year bond, or that would go under long-term assets. So I'm not really sure what that is. All right, so there's my receivables. How do you think I'm going to forecast receivables? Percentage of what? Any guesses there? Not assets. Your accounts receivable are receivables on what? Your revenue, right? Percentage of revenue or sales. So let's try that. 172 divided by our revenue. Now, how many of y'all owe Costco money? You probably don't, right? You use a credit card. So it should be a small number, I would hope. Well, let's try that. We'll copy that across. And then y'all know what I'm going to do, right? Put a graph in there and let's just look at it. Looks pretty stable, right? Between 0.8 and 1.2. Does 1% seem reasonable? Bond, this is your company. Does 1% seem reasonable? Seems like a reasonable forecast, right?
Yes, I think so.
I mean, you're assuming this is a really small number because they're not a business to business kind of operator. And it's possible they have some deal with like what were you saying, Bond? It's like preschools, and they maybe have some, but it's sure not showing up there. So we're going to use 1%. It's our forecast. We want to go 2 decimals just to keep it consistent. So we have already got accounts receivable forecast. We just take the 1% times our revenue. Got accounts receivable there. I like to put the dollar sign. Y'all already know what I'm going to do next, right? Y'all getting used to this? Before I go any further, I do a quick graph. Does that seem reasonable?
Yes.
Reasonable, so no problem there. All right. The next one is inventory. How much time do we have? We have till 4 o'clock, right? So, all right, so inventory. So let's go get our inventory balance sheet. Column I. Now this is an important number, right? So this is one we really want to be careful of. What are these other two things we have here? Deferred tax, current. Deferred taxes has nothing to do with inventory, so we'll have to handle those separately. There's our inventory, a huge number, probably one of the bigger numbers on the financials. So we'll copy that across. I don't know why I had green there. I will.
This could be copy or exhibit.
Oh, certain road. Yeah, so I'll just bring it down here. All right, anybody I want to guess on inventory percentage of, I said it last week. So if your inventory is most likely related to what? On the income statement. Any guesses, Vaughn, Sergio? What's on the income statement related to inventories?
Revenues or cost of goods sold?
Cost of goods sold is where I would put it. Now watch what we can do. If you want to say percentage of sales, here's what I like to do. And I think this is kind of a quick way. I do equal core. I'm going to do inventories. And I'm going to correlate them to revenue first. See, is it coral? Yeah, forget that's a pretty high correlation. That's to revenue. Let's do the same thing to cost of goods sold. It's a little deceptive. You're going to say like, wow, I got a really good R squared, but that's what you expect just because Costco's growing, right? So as their revenues go up and their inventories go, you're expecting high correlations. Which has a higher correlation? That's revenue, and that's revenue, and that's cost of goods sold. It actually is slightly higher correlated to revenue. That doesn't make sense to me, but it's awfully close. So I'm going to go with cost of goods sold just because that's the normal way to do it. But yeah, so Bon, you're right. Revenue is slightly higher, but it's 99.8% correlated. So, all right, so we're going to do it as percentage of cost of goods sold. So I take my inventory divided by cost of goods sold.
Maybe it's slightly not correlated due to shrinkage in some periods.
Maybe, yeah, that's such a small difference in correlation. Yeah, I don't know. All right, so let's look at that and just see if we're seeing anything out of the ordinary. First of all, it's come down quite a bit. Here's the thing, you have to be worried about what they're selling. So I would think groceries has a higher turnover than non-groceries. If they're doing more grocery now, that would maybe have an influence. If they're doing more flat screen TVs, you would hope that turnover is slower than bananas. If you look at the access, boy, it's really pretty tight. So it goes between 8% and 9.2%. The recent number has been much more on the lower side. And I'm not sure what's happening here. I'm tempted to go with 8.4 because I'm not sure, maybe even 8.6, maybe 8.6. I'm not sure how much COVID is driving that. My guess, and I don't know, my guess is people were buying more groceries last year just because of the COVID, but I don't know. Bon, you know that better than I would, but I'm going to go with 8.6 unless someone has a better solution there. Any disagreements with 8.6?
I feel like cost of goods sold is usually, like, converting. But I would personally do a rolling average.
Yeah, you can certainly do that. So what was the average for that entire period of time? The average is 867. So yeah, if you want to say, yeah, it's more likely to go back to its norm. I do think they've changed over time, so I would assume the more recent years they've averaged 8.64. And so the more recent years and the longer term are about the same. So 8.6 seems pretty reasonable to me. Any disagreement, Bond? This is your company again.
8.6 sounds good to me.
All right, so 8.6 times cost of goods sold. What am I about to do next? Any guesses?
Graph it.
Graph the whole thing. Yeah, I always do that just in case I had some.
If you go to recommended charts, it might show, I don't know if we're going to use them later in the paper, but it might make it easier to use later.
Recommended chart, I mean off of Excel?
Yeah.
Oh, yeah, I don't know what they would. I usually use a line, so I don't know if they would recommend a line chart or not, but that seems reasonable. I mean, this is a firm that's been incredibly stable and COVID's the only outlier, so. All right, so let's keep going. The next one's deferred taxes and other current assets. So let's go look at it. We could obviously do deferred taxes as a percentage of income tax, but the question is it even material? So this is a firm with, let's see, with $3.6 billion in assets, and deferred taxes have averaged $209 million, and there's some zeros in there. Why are there zeros? Because sometimes it flips to a deferred liability. The other current assets is pretty small. I'm tempted, okay, I'm gonna cheat. I'm tempted just to go other current assets. But let's see. All right, so if we do that, then we just got those two lines. Column I, what are they? Lines 28 and 29. And it's going to give me that error message again, right? No, they didn't like that. All right. There's something wrong with my Excel, and it's probably a cap IQ issue. Column I. Copy that across. Let's graph it and see if anything wild is going on here.
Deferred and other current assets here.
Yeah, yeah, deferred. So yeah, deferred taxes, you would say, oh, that's obvious percentage of income tax, but I bet we would not find a good relationship there. That's the accountant. I have no idea what the accountants are doing with deferred tax. It's like they said, you know, our profession is not complicated enough. Let's throw in this wild thing. It looks like it's just growing with the business, except something wild happened there. So just growing with the business. So let's try. I'm going to do this as percentage of assets. And I'm actually going to calculate it just because I'm curious about it. So we're not going to be able, I'm going to have to go back to the asset page and get the total assets. But I'm just curious just to see what it looks like over time. If we have something really crazy going on here or not. It doesn't, see, it's pretty immaterial. So that's kind of the advantage we have, even though that makes us feel much better, right? Because it's when you take it for the size, like, I mean, that big shoot up is just because the company's getting bigger. So the only thing that's unusual are these few years here. And it looks like we undid whatever that was. That could have been related to the tax law change. Firms saw some huge changes in deferred taxes during that time. So I'm going to go with the assumption that, you know, whatever that number is, what is that, about 2% of assets is going to be a good answer. All right, so we'll do that. I'm going to take this out because we're going to calculate this again when we get total assets in there. All right. So you see, it's somewhat of an iterative process. You just go one item at a time. All right. So the next one is property, plant, and equipment, accumulated depreciation, and net property, plant, and equipment. I can't remember what I did when I did Facebook. If we did the net or if we did the two pieces. Let's try the net. We might not like that and come back. But for Costco, the advantage we have with Costco is they have a very normal number of stores that they add. So it should be a fairly reliable number. So it probably shouldn't matter, but we'll try. So balance sheet, net property, plant, and equipment, column I. Put that there. Copy that across. I'm going to go ahead and put this one down here at 2%. Other, so I won't forget what we already decided. All right, so net property, plant, and equipment. Here again, we're going to do percentage of assets. And I'm just going to test it and see if it's, my guess is it's going to be pretty reliable number, but we'll see. It's huge, right? Because it's a big part of their business. But given how consistent they are, it looks like it's actually come down some. So it has come down. You know, to me, I was thinking about this the other day. If they're adding 25 stores a year, then it should be coming down because 25 stores is a smaller percentage every year. It's not like they add 25 stores and 30 stores, and you know, that they don't add 10% more stores, they just add 25. So it makes some sense that it would be coming down. It looks like the average is right at 50%, but that looks pretty predictable there, that we can get fairly comfortable with that. So I don't have a concern with doing a percentage of assets. If you didn't do percentage of assets, what would you do? So this is going to be part of the challenge. On the cash flow statement, we're going to have cash for investing, and that's where we're going to have to kind of figure out what CapEx is, and we're going to rely on that line to do it. We'll have to break out the depreciation from that. So we'll have to do some math there, but the math's not too difficult. The increase in property, plant, and equipment minus the depreciation or add back the depreciation will tell us the cash that we have. So it's not a hard formula at all. So we'll figure that out. So I don't mind using the net. It's going to work well. All right. Now let's look at these other things and just see if there's anything important that we need to add. So I'm just going to, I'll delete this later, but I'm going to do an equal sum. I just want to know what's in there. All right, goodwill. Oh, boy, goodwill. Boy, Bond, you know what they did? They wrote something off, right? The goodwill went from 988 back to 0. So it's like they bought something else, and then they got rid of it. So I don't know what that means, but we can probably put goodwill at 0.
In the year 2000, they bought, or 2020, they bought Innova Solutions for $1 billion, which was their biggest acquisition ever.
And I wonder if they either had this, if they didn't sell it, I wonder if accounting made them write it off. That goodwill, you know, that's kind of the below market kind of thing you have to do. Long term, I'm thinking these we can assume as 0. So I'm not really that concerned about those. What is this next one? Again, deferred taxes. I don't know why it's 0 here. Maybe it jumped up into the current or something. So we might have to deal with that one. This last one, other long-term investments, that one's gonna be a problem. So we have our first problem kid right there. What is that 3.81? So I'll have to go research that. I don't know, Bon, you know what that is off the top of your head, but they have something they did unusual. If you take out that, well, it's still a big number. It's a pretty sizable number. My concern is that it's maybe something COVID related. And as such, it's going to go away. So this is something where I might look at the quarterly statement and see if that item disappeared. You know, that kind of thing. So I have to do a little research on that. So that's one we'll have to research. But I'm going to go with these three being 0. And then this one, we might bring it back in at some rate. We'll see. It's a decent number. All right, so we'll have to work on those. So we'll work on those next time, and let's look at the liabilities. I don't think the liabilities going to be a huge issue. This isn't a bad way to do it, right? Because it can kind of tell you what do you need to worry about. Accounts payable, obviously, accrued, obviously we'll do that. Debt, we're going to put in debt, so that's not a, debt we'll handle separately. Leases, do they have leases today? Yeah, Bond, it's really strange. Costco has items just go to 0. So I think the leases we can probably put at 0. Current income taxes, that's been essentially 0. So that's 0. Unearned revenue. All right. So what in the world is their unearned revenue? You have any idea what their unearned revenue is? Bond, that's a big number. Y'all know what unearned revenue is, right? Their customers pay them in advance. What in the world is that for Costco? So that's something, huh?
Would it be like online order stuff? Maybe gift cards?
Could it be memberships?
Gift cards, yeah, that's probably is it. Sorry, what'd you say, Bon?
Would memberships be in a possibility?
Oh, that's another one. Yeah, that's true. Both of those would be good because you pay membership annually or monthly?
Annually.
Yeah, so that would definitely be there. So gift cards and membership would both be ones to look up. So there's something else to do a little research on. Deferred tax is nothing. And then we'll do other probably as a percentage of liabilities or something. So that one won't be a big deal. All right, so, and that one's very, very consistent. You can see that one's, well, it did do a big jump right there, but fairly consistent the last few years. All right, so next week we'll finish that up. We're getting close. And then the fun thing is once we get that, we get to build a cash flow statement, which I always love doing. So if you want this file, email me and I'll send it over to you. I kind of like doing forecasts. I think it's a test of if you really know accounting. All right, guys, thanks a lot.
Wait, so in the chat, can y'all see Coin 360 here on the right side? Yeah. Yes. Okay. Lola says yes. Sweet. All right. Thanks for coming to class today. First of all, we're just going to take a look at the market. So it looks like Bitcoin is at 65,964. So we're around at 66K. Ethereum's at 41. So we broke that $4,000 support level, which is pretty good. Cardano's sitting at 218. So we've been hovering the 220s for a while there. Solana is popping off pretty well. We're going to talk about Solana today. So in August, Solana has been really gaining a lot of traction, mainly due to its opening of the NFT marketplace that they are supporting through their blockchain. So that has just skyrocketed the price there. So we're going to go back to Cardano here, which is at 218. And then we can see, and y'all can see the charts here, right, in the Jay and Lola. Y'all can see these charts that I'm flipping through?
Yeah, if you do the share.
No, it should still be sharing. I just want to confirm. Okay, they said yeah, sweet. All right. So over here, you can see Cardano likes to do kind of like a stair step motion with this price movement and price action I've observed. So you'll see these really rapid gains. And then you'll see it kind of just be very horizontal for a couple months, and then you'll see a boom, a big spike, and then horizontal, and then boom, a big spike, and then horizontal. So right now we're in a horizontal phase where we've been, the peak was around $3. I remember I actually sold a little bit there. So I was like, $3 is like a psychological, not like a price level that I just was like, so just a couple percent of it. And then whenever Bitcoin hits a new all-time high, I sold off like 15% of my Bitcoin to and I'm reinvesting it into other crypto. So I usually, whenever I sell my Bitcoin, if I'm taking profits, I reinvest it into other tokens. Like I'm always keeping the cycle going. Yeah, that's what Cardano's been looking like. Let's go to Ethereum. All right, so Ethereum is sitting at a market cap of around $480 billion. So that's pretty solid there. And then right here, you can see the price movement since January has been just of this year has been just skyrocketing. It took a big crash from May to June, July over the summer, but now we're having a pretty strong recovery. And then whenever I see this pattern a lot with crypto is when you'll see just a crash and then this like cut pattern. So the fact that it's breaking this resistance and going to a new all-time high is a really good sign of just a bullish momentum of the market right now. So let's go to another one of our resources, which is going to be CoinGecko. And let's see the total market cap. So the global cryptocurrency market cap is at $2.76 trillion. This is up 4.5 in the last 24 hours. So this is really awesome. Bitcoin is sitting at $1.2 trillion in market cap. So to put this in perspective, let's go top 10 companies in S&P. All right. So Apple has a market cap of about $2.3 trillion. So if we go down, let's go down to Facebook. So yeah, right now, the whole crypto market is larger than the whole entire market cap of Facebook in monetary value. I see a question.
I don't remember where I saw this, but I just remember somebody saying that like they achieved that 1 trillion mark of market capitalization, quicker than any company ever.
Exactly, yeah. So I think what you're trying to say is like if Bitcoin was a company, it would have reached a $1 trillion valuation faster than any company in history. And that's absolutely true. If you look at any asset in the past decade, Bitcoin is one of the strongest performing assets if you compare it against anything. So yeah, I mean, it's great to see it, and it's great to see it continue to grow. And just it's cool to put it in perspective sometimes. So like, we're approaching the market cap of Amazon as a whole entire company as crypto. So that's just like how big and globalized the infrastructure is, which is good. Today I really wanted to do a deep dive on three. We're gonna keep it very simple. We're gonna talk about three currencies today, and so none of them are gonna be Bitcoin. So we're gonna talk about Ethereum, we're gonna talk about Cardano, and we're gonna talk about Solana, because these three projects I think are really some of the top dogs that have really shined. They've been in the top 10 pretty consistently in the recent markets. So I took Solana is the newest member there. But let's go ahead and start with Ethereum, because Ethereum really is like the OG in the sense of altcoins. So it's like the first one to really branch off from Bitcoin. Just to kind of walk you through the process. So when you go to CoinGecko or CoinMarketCap, whatever you want to use, they give you really a lot of resources on kind of the ecosystem of what you're looking into. So let's just go to the Ethereum's homepage just to kind of see what they're up to recently and what Ethereum is all about. So Ethereum is community-run technology powering the cryptocurrency ETH, and thousands of decentralized applications. So Ethereum, in the words of the founder, Vitalik Buterin, is like a general purpose blockchain. So it's basically trying to apply the blockchain technology, which we talked about, the terms last class. We're applying this blockchain technology to hopefully useful applications in the world. So some of these projects have been NFTs, some of them have been play to earn games. That's another big one that's coming out recently. So I would look into that, especially as people in college, everyone loves playing video games. So might as well make money while you're doing it, right? So Ethereum has kind of enabled these things, concepts like play to earn. So I have this friend in Austin, and he's farming these Axie Infinity NFTs. So there's this game called Axie Infinity. It's a game you can play just to see what you can look at, just what it looks like. These characters are they're literally, it's hard to describe what they look like other than seeing them. So let's see if this loads here. But yeah, they're like little cat-like creatures. So so it's a play to earn game in which you can battle and have these games. But one of the things you can do is you can breed them. You can breed these creatures together. You can basically take an egg and create it's randomly generated, kind of like there's a luck system in place where you can get a really good egg that gets a super legendary, Axie character, and then it's worth a bunch. Or you can get a really low value one. So there's kind of some luck of the draw game there. So anyways, my friend is farming these and basically trying to breed them and then flip them to people who play it. So I think it's just a kind of an interesting application of crypto. And it kind of just opens the door of maybe this isn't going to be the end all be all, but what is going to come after this? What's the Axie 2.0 that's going to come after? So you can start to see how Ethereum has enabled, creative people to, basically do things with their blockchain. So yeah, so this is kind of a little bit about ETH. So another thing about Ethereum that you need to know is the transition to ETH 2.0. So ETH 2.0, the biggest, thing you need to know about it is that they're moving from proof of work to proof of stake. So ETH 2.0 is trying to solve for the sustainability problems that y'all were talking about last class with Bitcoin, which are very valid. And those points are around consumption of power, simply, electricity. We need electricity to run society, and we can only allocate a certain amount places, right? So if crypto really wants to hit the mainstream, we need to find ways to solve that problem. So that's what they're trying to do by going to this proof of stake system. So you can see here, these are the three main points of this. So it's more scalable. So Ethereum needs to support thousands of transactions per second. As y'all saw during the first class, when we go to OpenSea to try to buy an NFT, the mining fee is $150 for a $15 NFT. So you can see how the scalability is quite literally right now not good. There's problems, and no one wants to pay that fee. We want crypto to be low cost, and people use it because it's low cost. So more secure Ethereum, this is going to be just a security upgrade. Ethereum has been hacked before. You should look into the DAO hack. So Ethereum has been hacked for millions of dollars, and it's pretty controversial what they did. They basically split from Ethereum Classic to Ethereum regular. So if you look if we go back to Penguin Gecko here, that's where Ethereum Classic comes from. And so if you're ever, so if we go to rank number 30, if you've always wondered where did ETH Classic, that's what happened. So after the DAO hack, the hardline Ethereum Classic people basically said we cannot alter the blockchain and basically revert to before the DAO hack. Because that's what happened with ETH. They really altered the blockchain, which is kind of like, you're not supposed to alter the blockchain because it's supposed to be a record that's like set in stone, right? That's the whole point of crypto, right? It's secure. So this is a huge thing that happened back then, but they found a solution to it where they basically reset it. And but then that's how ETH Classic got spawned. So I probably didn't say it in the best way. There's definitely YouTube videos that you can watch about whole documentaries about this hack that happened and how the split happened. But it's just important to know that this can happen, and it has happened before where a currency can split, and it's called forking is the term.
Actually, made a video on Ethereum and he summarized it pretty well, I think.
Mm-hmm.
I kind of, I don't exactly remember what he said about it, but he broke it down in like a couple of sentences, basically, people wanted to revert those fraudulent things from the hack, and they increased the amount of Ethereum that was up there.
Yeah. Yeah, they found a solution to it, and basically that's how it was created. That fork, that's how Ethereum Classic was created. So back to ETH 2.0, Ethereum is also trying to be better for the environment. Like I said, it's trying to reduce the amount of computing power. I also see a question from Jay. Is there a difference in security between the different Ethereums? What is the difference between Bitcoin and Bitcoin Cash? What is a fork? So good questions. Ethereum 2.0 is supposed to be more secure than Ethereum, like the original, like Ethereum, let's just call it 1.0. So this is another instance in which there was a split in the community in which, let's pull it up. Well, actually, no, we're not going to go too far. We're gonna. That's a whole nother topic. We'll go back into that. Right now, we're going to stay focused on Ethereum, Cardano, and Solana today. But that is a great question, Jay, for another class. I'm going to go into the Bitcoin Cash split. But just the 2-second summary from what I remember, basically Bitcoin Cash was trying to solve for basically making it easier to spend it as cash, because a Bitcoin's, just like Ethereum, has the mining fees, and that has made the cost of transactions higher. And Bitcoin Cash basically is like Bitcoin, but you have like a 1 cent transaction. And that's the idea, right? It's more scalable, bigger block size. But we'll go more into that later. So Ethereum 2.0 is, there's there's a lot of memes about the Ethereum 2.0. When will the 2.0 finish? Look this up.
Check out the burn account. I know they added a new burn feature to some of the fees. Oh god.
Are you talking about ETH 2.0?
Yeah.
Yeah. So I think I've heard about that. Yeah. So what basically, for what people don't understand what burning is, when a project wants to reduce the supply, so you have the cost of the coin and then you have the supply. So when a project can burn some of the supply and basically reduce the supply, which basically, with the laws of supply and demand, usually makes there's less supply, the price usually goes up a little bit. But that's what happens with the new update, is they're going to start burning the mining fees to try to reduce the total supply. So this is kind of a meme, like ETH 2.0 finally ships, because it's supposed to have been finished for a while, but it's still, not there. So let's look at an ETH 2.0 timeline, because I forget what phase we're in already. So Ethereum's 2.0 first phase launched on the 1st of December of 2020. However, with the 2 phases still to go, the full release is still not estimated to happen until 2022. So we're still a full year and a couple months out for their expected date. But I mean, even from then, they can delay it as much as they want. So, you know, for me as a miner, I'm super down for this. I'm cool for it because I'll down a mine for another 2 years while they're still figuring out the whole staking thing. But it is important to know that if you want to get into mining, you want to consider that you might not be able to mine Ethereum forever, right? You know, you might at some point in time have to switch your mining operation from Ethereum to a different type of coin. So a resource we can use for that is what to mine. Hello.
What are you mining?
I'm mining Ethash and Kapow. So
Did you build your own rig?
yeah,
Out of what? ASICs? What kind of
GPUs. I got two 3070s and a one 3080.
NVIDIA?
NVIDIA's, all NVIDIA. So the whole rig altogether was around $5,000, and as of today, I've mined about $3,000 worth of Bitcoin.
I'm mining helium right now.
Yo, I've ordered a helium miner. It still hasn't come in yet.
Miner.
Huh?
The radio frequency miner.
Yeah.
I don't have to do anything.
Exactly. No, that's awesome. I'll definitely. I'm going to cover that in a different class as well. Helium mining, but yeah, no, that's another really cool option to get into crypto.
I'm trying to build a rig. I didn't know that y'all freaking are talking about this stuff.
Yeah, we have a class that goes on. It's gonna be every Wednesday at 7 p.m. Right here in this room. Yeah, no worries, no worries. I'll catch you later, man. Well, see, you never know who's you're gonna run into that likes crypto. That's the beauty of crypto is a lot of people are interested in it. And so, anyways, this is what to mine for the people who are interested. Right now, Ethereum is number one, profitable coin to mine. But you can see here, Raven Coin, ETH Classic, Beam. These are our other options. So let's say Ethereum goes 2.0, you can't mine anymore. I'll just switch right to these guys. So that's just another thing to consider with ETH 2.0 coming through. So any questions about Ethereum? Does anyone have any burning, desiring questions about Ethereum? Anything they don't understand? Y'all kind of get it, Ethereum by now? Or what do y'all think about Ethereum? You like it? Don't like it?
You got the most potential.
You think it has the most potential? I think a lot of people said it has a lot of potential. It really has been consistent over the years. So, yep. Oh, to the moon. Okay, yes, to the moon. I agree, man. I agree. And another big point that people usually give for Ethereum is that it has the largest decentralized app ecosystem under it. So going back to Coin360, ETH has a large market share when it comes to those applications.
Do you think ADA will ever eat Ethereum?
So I'm glad you asked that question because that's where we're going to go next. Is we're going to talk about Cardano or ADA or ADA, which is the ticker for it. But Cardano is a very interesting project, and I really am passionate about it because I think that one, they invented proof of stake. Two, they have their own crypto algorithm in which they invented called Ouroboros. And then thirdly, it's peer reviewed. So they have a process in which everything they do is peer reviewed. So we're going to go to the Cardano.org website, and then we're going to go to the Cardano timeline.
What's the next one coming up? We're just past the launch on Purple,
I think.
It's like the timeline.
Yeah. So yeah, that was a great question. So this is the Cardano roadmap. These are all named after famous mathematicians. Some of them are really from like the olden times, and then some of them are more recent. But basically, it's phased out the way that Cardano is going to be developed, and each part is going to add something different. So Byron is the foundation. So Cardano basically is a third generation blockchain created from the ground up using research, peer review, and rigorous formal development model. Began in 2015, it was formally launched in 2017, and the Byron era began. Second phase was Shelley. This was decentralization. So following from the Byron era, Shelley era of Cardano is a period of growth and development for the network, unlike the Byron era, which began at a single point. When the mainnet was launched, the transition to Shelley is designed to achieve a smooth, low-risk transition without service interruption. So this allowed for it to be decentralized, in which before Cardano was kind of being parallelly run with IOHK. So IOHK is like the sister company that basically built Cardano. And then what happened was super cool is after the Shelley update, they basically transferred the blockchain to the stake pool operators. So the stake pool operators have full control. It's a fully decentralized system. So IOHK, although it was like the centralized company that built it, they metaphorically kind of turned on the project and let it run, and let's let it run itself.
So that's like their DAO?
Essentially, yes, essentially. And then the Goguen update, this added smart contracts. So this added the ability to add decentralized apps under the Cardano ecosystem. I'll make sure to close the door. And then, so the benefit of this is basically what the capability of Ethereum is. One of the big things is these decentralized apps. So in a way, Cardano is competing with Ethereum, and we'll see in the long run, the market will decide which is the winner and which is more efficient. Because if you're a miner or if you want to buy and sell NFTs, and one fee is $150 mining fee, and then one fee is like $1 Cardano mining fee, that competition is going to breed and benefit the consumer at the end of the day. So scaling is the Basho era. This is going to be the era of optimization, improving scalability and interoperability of the network. So this is going to be trying to focus in on the decentralization and the functionality of scaling up. And really, that's kind of what you're going to hear that a lot of projects are trying to solve for that whole scaling issue. And then lastly is going to be the governance. So this is the Volterra era. And this is the final piece where it ties everything together by introducing a voting and treasury system. This way, the project will have support in the long run. So a lot of people ask, like, what happens when the last Bitcoin is mined? And how will Bitcoin continue to support itself if all the Bitcoins are mined in 20, 30 years or whatever. So that's a key problem that the whole governance idea of Cardano is trying to implement with this fifth phase, is the idea of governing your monetary network in a safe and fair way, so it doesn't become prey to the issues of like the traditional finance system, right? So governance this is going to be a key era to look into with the Cardano. So yeah, that's kind of it at a macro perspective. But in the micro perspective here, Cardano is been around the top 3 market cap coins recently. And then if we go to, let's just go to the Twitter real quick and see what they're all about here. So they have a lot of collaboration with not only countries in like Africa, where they're trying to empower them to create their own, decentralized systems for their government. For example, IDs verification system, basically running on the Cardano blockchain. So imagine your driver's license was tied to the blockchain, and they could verify it that way. And having a whole, government and whole system basically running off the blockchain. So it's taking decentralization to the third, it's like the third wave of decentralization, in which, the first wave was kind of like the proof of concept. Bitcoin is like sound digital money, where it's like sound money and you can kind of count on it appreciating over time. And then you have Ethereum, which is kind of like the app store. I like to say it's almost like the app store of the blockchain. And then Cardano is trying to be like Apple, like it's trying to have this whole ecosystem, that it really spreads around to the world and hopefully does some good. So yeah, no, it's cool to see Cardano continue to grow. What's an interesting backstory of Cardano is Charles Hoskinson, the founder of Cardano, actually was one of the people who co-developed Ethereum. So he came from Ethereum and had different ideas than Vitalik Buterin on how a blockchain should be, run, what the whole purpose is. So he went and started his own foundation, started his own thing. So that's kind of the genesis of Cardano, came from the core ideas of Ethereum. So I'm both an Ethereum lover and a Cardano lover. I mean, I think I will be happy if both of them succeed. Me personally, if I were to pick one or the other, I do think Cardano has a better long-term future, because I really think the ability and the approach that they're taking with their blockchain is really solid. And they're very transparent with what they're doing, and the timeline of how they're doing it. And the fact that they rolled out proof of stake long before Ethereum has, and it's been running smoothly, is a really good sign. So let's continue. Hopefully that momentum will continue, and we'll see the market cap of Cardano pass up Ethereum. But right now it's at 70 billion, which is it's like a fourth or fifth of Ethereum. So it's still got a lot to go. And you can see here, it's like it's a tiny square.
It has more room to grow.
It does have more room to grow. So yeah, that's another benefit of Cardano, is like, if you put $1 in a Cardano, you put $1 in Ethereum, $1 Bitcoin, you're more likely to make like $3 on your Cardano investment, $2 on your ETH investment, $1 on your, the more, the higher market cap it is, the smaller growth you're going to get. You're not going to get as explosive growth, which is fine though. Like, holding Bitcoin and just getting that small percent, like 6% APY on my Celsius, like I'm super cool with that. I can do that for 5 years and just watch it grow over time. So yeah, Solana is going to be the third one we're talking about. We'll do it pretty quick here. As we're talking about it, it's been just going up, which is awesome. Good to see. But let's go check into Solana here. So Solana, powerful for developers, fast for everyone. Solana is a decentralized blockchain built to enable scalable, it's a big buzzword, scalable, user-friendly apps for the world. So you can see here, it's transactions per second, 2,498. Average cost per transaction is less than a penny, like very small transaction. It has a 1,100 validator nodes. So these validator nodes these are like kind of like stake pool operators. So they're the people running the blockchain. And you can see here the ecosystem of these are all the applications running on the Solana network. So you'll have whole NFT ecosystems on the Solana network. And then that's what's been driving a lot of the growth, is the collaboration with all these companies. So it's interesting to think about how, like, a lot of these, not all of them are going to be successful projects, but some of them will be.
You said you got into crypto in like 2017, right?
Originally I got in back in like 2015 when I was in high school with my friends, but then I was on and off with crypto, up until 2017. And then after 2017, I was wasn't into crypto for another like 2 years. And then I really got into it in 2019, like started to really dive deep down the rabbit hole. So
I was just gonna ask if you remember any of like the hot currencies that were like really popping as and then kind of disappeared.
Yeah, exactly. I remember in 2017, there were a lot of ICOs. ICOs are initial coin offerings. Think of like IPO, but for crypto. So what happened in 2017 is Bitcoin started to hit these all-time highs around 18 to 20K. There was a bunch of bullish news on it, and the price just skyrocketed. And you can like, let's just go to the chart, just to relive the story, because you can just. I think you can see the story by just looking at the chart. So it's kind of hard to see. Change the time. So this is 2017. So this is the 2017 bull run right here, where from September we went from like $3,000 a coin to it peaked around like 18 to 20. This was the 2017, and then we had this 2-year long bear market where it was just mayhem. Projects were being cut from 70%, 80%. You saw your whole entire portfolio just be cut into a quarter, of what it used to be. And it was tough times. And then this is when a lot of people kind of like, shook crypto off and kind of thought it was dead technology. But 2018 was when we had like that spike and everything. And then, really after 2020, that's when we started to have this second bull market, which you can see here is significantly larger than the first bull market. And that's because we got the big boys now. We got the institutional players. We have crazy volume compared to what we've been used to dealing with. So, yeah, I mean, I think if we scale this out even longer term, you can just use your imagination of where it's going to go. But I mean, I think it's really just a long-term play. Like, you have to be willing to survive these horizontal periods of time, which do happen in the market. So you want to catch the waves while you can, and then ride them for as long as you can.
Have you thought about, or just the possibility of like, in the event of this bull run ending, like any way to like hedge against your holdings so you don't have to sell? Maybe like short selling?
Yeah, I see what you mean. I mean, everyone's got to have a different strategy when it comes to which they take profits. And, I think it's really important to have a game plan of like, you got to have certain price targets where if it hits that price, you're going to sell a couple percent. But like, to your point of like, if you don't want to sell, what you can do is you can take out loans on your crypto and then like just pay the loans back. But in that case, it's adding another complication. So it's just however you want to do it. You can make it really simple, simple cash out strategy where it's like, if it hits this price, I'm taking out half. If it hits this price, I'm taking out a quarter. If it hits this price, I'm taking everything out and just holding cash. Whatever your strategy is and whatever you think those price points are, you got to start developing your own model, because that bull run happens quick and the bear run happens even quicker. And I mean, it doesn't take a genius to realize that like there is going to be, right now we're at all-time highs, but there is going to be another bear market. So I just want for y'all to prepare yourselves for that, because I don't know if y'all went through the 2017, who went through the 2017 bear market, like really felt it? No one? Okay, so y'all haven't experienced what it's like to go through that yet. So it's important to, along the way, if you're up, a bunch of percent, to start taking some profits along the way. But it's also okay to just hold for the long term. If you want to just wait, if it dips down and you just want to buy more, go for it. I mean, it just depends on what your strategy is. That's why dollar cost averaging is so powerful. Another question?
So why that bear market happen? Do you know?
So, I mean, there was a lot of reasons. It's kind of important. There was a lot of the ICOs started to become frauds, and it was there is a market psychology to the crypto market where like money's put into it and then money's taken out of it. Because essentially that's what's happening is the world is putting trillions of dollars into this asset class that has never existed before, and then taking out profits along the way as more and more people are buying in. So it's almost like, you know, you never know when the bear market's going to happen. But all you can do is manage your risk. So it's kind of like surfing. Like you got to have your, you know, the waves you want to hit. You got to have your strategy about exiting the wave too. You know, because if you just keep riding it, you know, you might just hit the shoreline. So you got to think on from the buy side and the sell side of things, and just have your own strategy and what your time horizon is for your investment.
So you've done option trades on your Tether, right?
Yeah, I've been doing futures trading through my KuCoin. Yeah.
So how do you, I've heard this concept that when you're trading options, you have to take into consideration implied volatility because it's mean reverting. So even if it passes your price point, if implied volatility dips so low that the market won't buy your security anymore, you can get
Caught out. Yeah, and I've made many mistakes when I've traded on my futures account, and I'll be honest with you, I've taken accounts to zero like multiple times. So it's like trading is one thing, and then long-term investing is another thing. So it just depends on what your strategy is. What I do, and it's generally a good, you know, risk management tool, is like I take 80% of my pie, and you know, I lock that in for long term, and then 20% of my pizza, 20% of my pie, I will mess around and be aggressive with, you know, and I will put it on the line on a KuCoin and trading account, and I will learn and make some, you know, collect some bruises and learn how to trade, because I believe that trading is a skill, and if I just keep, you know, going at it, you know, throughout the years, I'm gonna become 1% better every single year, and then maybe I can just have it on the side, you know, where I have my main income, take it, and then multiply it ideally with trading. But there's no course that can teach trading other than like actually doing it. That's another thing. I've like checked out a bunch of courses, but not all of them.
check out this model called the high cycle top model?
Yeah, it's very, very popular. Let's see if we can see it here. So the pi cycle top essentially uses moving averages, and you know, usually what happens is when it reaches this green bar here, it usually will go bearish when it crosses. So right now, yeah, right now we are like right here. So
Yeah, I think the moving averages are just starting to.
yeah, we're getting
towards each other.
Yeah, we're getting close, but we're not quite there yet. Right now, but yeah, that's kind of where we're at right now. I think it's at 82,000 right now is where the pi cycle top is. So yeah, right. So that'd be interesting to see, guys. Let's keep an eye on Bitcoin for the next couple of days and months, and if we see it reach around 80K, let's see if we see a little bit of a sell off there. That may be a good time to take a little bit of profits at that 80K mark. Me personally, I think 100K is a huge psychological level that if we break through 100K, I don't even know how high we're going to go, but like, I think 80 to 90, you know, I think that might be, I don't like predicting the top of a, you know, the cycle, but roughly I would say between 80 to 100 for this cycle. But yeah, that's pretty much it for class today. I just want to talk about Ethereum, Solana, and Cardano, and hope you all continue research into cryptocurrencies. Thank you for joining us virtually, and I hope you all have a good rest of your day. And thank you for joining for the class. And